Come back to the exchange. Shares of Texas Instruments falling today, taking the chips with them after giving a weaker than expected fourth quarter outlook. You can see shares of Texas Instruments down about 7% right now. The company noting that while the semiconductor industry is recovering, it's happening at a slower pace than prior upturns. But Evercore just added the company to its tactical outperform list, telling investors to buy the dip despite lowering its price target. Joining me now is Evercore's Mark Lipacis. Did I get that right, Mark?
Yes, Mark Lipacis. Exactly.
Fabulous.
Thank you, Morgan.
Welcome to the show. And let's start right there. Why are you bullish now?
Well, I think, the CEO, like you said that the pace of recovery is happening at a slower than normal pace. The question is why? And we did a series of checks in the channel. And what we heard is that supply chain just spent 2 years lowering the inventory from the biggest build that they've had in 2 years, right? And so basically they have such bad PTSD from that COVID inventory build that they would rather pay expedite fees or broker fees to find chips that are in short supply than to rebuild their inventory safety stock. So normally at the part of the cycle, we would see an inventory rebuild downstream in the supply chain, but they don't want to do that. And lead times are stretching and inventories continue to deplete. So it becomes a bit of a coiled spring on the way up. That will happen, we believe, sometime in the next 6 to 9 months or so.
Yeah. Why 6 to 9 months? What is it about that time period that this normalizes?
Well, if you look at their guidance, it's actually, they delivered a seasonal quarter, which was a little bit better than expectations. They actually guided for a seasonal quarter, down 6% sequentially in the December quarter. So it looks like things are kind of ticking along. That we have, decent demand. You have very healthy end markets in AI and data center. Defense is very strong. You have certain parts of EV market that's strong. So it seems like chips continue to get concerned. But what our checks are telling us is that the supply chain is starting to get nervous that inventories are going too low. And one of the things that we heard on the Texas Instruments call is that the TI is lowering their utilization rates. And so you have to remember, it takes like 13 weeks to make a chip, right? And we saw this situation happen back in COVID when everybody got concerned. They lowered utilization rates. And then the next thing you know, the lead times start to stretch, and you can't just turn a fab on and start spitting out chips. It takes 13 weeks to make the chip. So our checks in the supply chain are concerned that sometime in the first half of the year, we're going to be in really tight supply. We'll be on allocation. Maybe it's the second quarter. Maybe it even is the first quarter. That's why our checks are indicating that.
Okay. Will you just touch on some of the areas where there's still some strength, data center, AI, EVs, et cetera? But overall, we keep hearing about ongoing softness in industrial and auto overall. Is there read-through to other parts of the semi industry here?
Yeah, and I think what's what we heard yesterday is by and large, industrial was about up 4% sequentially, and you'd hope it to be up a little bit more, a couple hundred basis points. Autos were up 10% sequentially, and communications equipment and enterprise equipment were up 10 and 20% sequentially. So we actually had some healthy demand, and I think it's important to understand in semis are a bit different than other companies in the S&P 500. A lot of companies in the S&P 500 sell directly to the consumer. The semis are way early in the supply chain. So they sell to distributors who sell to contract manufacturers who sell to OEMs, and they sell to their own distributors and so on. And so there's a pile of inventory at each one of these stops, right? And so, when things stretch out like they did in COVID, everybody builds inventories and semi revenues are really high. And then when lead times shrink, which they had over the previous 2 years, everybody blows out their inventories. So we're kind of at that bottom of the cycle, right? And so what kind of restocking you have may not necessarily be a reflection of the end market demand. And like I said, TI is guiding for a seasonal fourth quarter. And I would point out the last 4 quarters, they beat their guidance by 2 to 4%. So they're known as a very conservative company. And we actually are at the kind of the higher end of that guidance range.
Okay. A lot for our viewers to consider. Mark Lipacis of Evercore, thanks for joining me.